Ladies and gentlemen, good evening. Let me begin with a simple fact that has captured headlines and excited investors around the world. Silver has just hit $64 an ounce, a record, a psychological milestone, and like every moment when prices surge, it invites celebration, speculation, and, most dangerously, simplistic stories. You have already heard one of them. This is just the beginning. Silver is going to $100 and beyond. But tonight, I want to slow this moment down, because if history teaches us anything about markets, about capitalism, about bubbles, it is that when everyone is looking at the price on the screen, the real story has already happened somewhere else. Prices do not rise or fall on their own. They are outcomes, not causes. When silver hits $64, the question is not, how high can it go? The real question is, what changed in the system weeks ago that made this outcome inevitable? Markets, under capitalism, are not neutral arenas of supply and demand. They are structured by power, by banks, by governments, by corporations, and by speculative capital that moves faster than any physical metal ever could. When silver jumps like this, it is not a surprise. It is a delayed reaction. Weeks ago, before the headlines, before the retail enthusiasm, before the social media charts, large institutions were repositioning. Futures contracts were being rolled. Short positions were quietly reduced. Long exposure was built where the public could not easily see it. At the same time, central banks continued a familiar contradiction, publicly reassuring us about inflation while privately expanding balance sheets, sustaining debt and signaling, yet again, that real interest rates would remain weak. In such an environment, precious metals are not investments, they are symptoms. They are signals of mistrust in paper promises. Silver did not, suddenly, become valuable. What suddenly became obvious is that confidence in the existing monetary arrangement weakened again. Now let's talk about this seductive number, $100. It sounds scientific. It sounds inevitable. And that is precisely why it is dangerous. The narrative of 100 silver serves a function. It pulls latecomers into the market. It creates exit liquidity for those who entered earlier. Capitalism is very good at turning hope into a commodity. And speculative markets are where that process is most efficient. When people are told, you're still early, what they are often being told is, someone else needs you to buy. Silver as a working class metal. Historically, silver has always been the people's metal. Gold belonged to kings, empires, and central banks. Silver circulated among workers, merchants, and households. And that symbolism matters today. When working people feel squeezed by stagnant wages, rising living costs, unaffordable housing, they look for protection. Silver becomes attractive not because it will make them rich, but because the system is making them insecure. But here is the tragedy: the very system that creates this insecurity also structures the silver market. The worker's hedge becomes the speculator's playground. The trap: volatility without power. Let us be clear about the trap that was set weeks ago. It is not simply that prices might fall. Markets always rise and fall. The trap is that volatility is being mistaken for empowerment. Owning silver does not give you control over interest rates. It does not democratize the Federal Reserve. It does not change who decides monetary policy, who benefits from debt expansion, or who absorbs the losses when bubbles burst. Silver can preserve value, yes, but it cannot fix a system where gains are privatized and losses are socialized. The third hook: who wins when the crowd arrives late. Every major commodity surge follows a familiar pattern. Early movers accumulate quietly. Narratives are crafted carefully. Media attention grows. Retail participation spikes. And then, often suddenly, the same institutions that promoted optimism discover new risks. Ask yourself, who has the balance sheets to survive a 20 or 30% correction? Not households living paycheck to paycheck. Not small savers looking for protection. The winners are those who can wait, hedge, and exit without consequences. That is not a flaw in the system. That is the system. Silver at $64 is not a triumph. It is a warning light. It tells us that faith in currencies is eroding. That debt has become permanent. That growth is increasingly financial rather than productive. When money flows into metal instead of factories, schools, or infrastructure, it tells us something profound. Society no longer believes that the future will be fairly distributed. And that is not a metals problem. That is a political economic problem. A word of caution. Not cynicism. I am not saying silver cannot go higher. It may. Markets can remain irrational longer than individuals can remain solvent, as the old saying goes. But chasing price targets without understanding power structures is how ordinary people are repeatedly disappointed. The real danger is not missing the move to $100. The real danger is mistaking speculation for security. Price movements reflect systemic shifts, not sudden demand. Silver reaching 64 is not a spontaneous market event. It is the delayed outcome of earlier institutional repositioning, monetary expansion, and weakening confidence in fiat currencies. Speculative narratives serve capital, not public understanding. The popular 100 up silver narrative functions to attract late-stage buyers, providing exit liquidity for larger players who entered earlier under less visible conditions. Precious metals signal monetary stress, not economic health. Rising silver prices indicate instability in currency systems, persistent inflationary pressures, and structural dependence on debt rather than genuine productive growth. Volatility transfers risk downward. Market volatility disproportionately benefits institutions with capital buffers and hedging tools, while exposing households and small investors to greater downside risk. Silver as a hedge does not alter power structures. While silver may preserve value, it does not change who controls monetary policy, credit creation, or crisis management within the capitalist system. Commodity surges reflect political, economic contradictions. Capital flowing into metals instead of productive investment reveals deeper failures in income distribution, wage growth, and long-term economic confidence. When silver reaches $64 an ounce, the instinctive reaction is to treat the moment as a sudden surge driven by excitement, headlines, or a rush of new buyers. But markets do not operate on impulse, they operate on structure. Prices are not the engine of economic change, they are the dashboard. What we see on the screen today is the delayed reflection of decisions made earlier, often quietly, and by actors with disproportionate influence. The real story of silver's rise began weeks ago, long before it appeared in public conversation. Large financial institutions do not react to news the way households do. They anticipate it, position for it, and frequently help shape the conditions that later appear as market moves. In the weeks leading up to this price level, futures markets showed subtle but significant shifts, reductions in short exposure, strategic accumulation of long contracts, and changes in hedging behavior tied to expectations about monetary policy. None of this made headlines, but all of it mattered. By the time the price moved decisively upward, the groundwork had already been laid. At the same time, macroeconomic signals were sending a clear message to those who know how to read them. Central banks continued to project confidence while sustaining policies that erode purchasing power over time. Real interest rates remained weak, debt levels stayed historically elevated, and liquidity continued to circulate more freely in financial markets than in the productive economy. For institutional capital, this combination does not invite patience, it demands repositioning. Silver, in this context, becomes less a commodity and more a monetary response. Here is the critical hook. When prices move sharply, it often feels like something new has happened, but more often something old has simply become visible. The public sees the result, not the preparation. By the time silver is discussed as breaking out, those with early access to information and leverage have already adjusted their exposure. What appears to be momentum is frequently confirmation. This is why focusing solely on price action leads to misunderstanding. The rise to $64 is not evidence of sudden scarcity or mass awakening. It is evidence of a system responding to its own contradictions, expanding money supply, fragile confidence in currencies, and capital seeking refuge from instability it helped create. Silver did not initiate this movement, it absorbed it. And when we recognize that, we stop asking how high the price can go and start asking a far more important question. What conditions made this outcome unavoidable in the first place? The story of $100 silver sounds persuasive because it is designed to. Round numbers carry psychological weight, and markets have always used them as magnets for attention, belief, and participation. But this narrative does not emerge organically from economic fundamentals. It is constructed within a speculative environment where expectations are as tradable as the metal itself. The promise of a higher future price is not neutral information. It performs a function, and that function is to draw new participants into a market that is already heavily positioned. Speculative narratives thrive at moments when uncertainty is high and trust in institutions is low. When people feel that wages lag behind prices, savings lose value, and official explanations no longer reassure, they become more receptive to stories that offer clarity and direction. Silver is going to $100. simplifies a complex monetary crisis into a single, actionable belief. That simplicity is its power and its danger. It turns systemic anxiety into a personal investment decision. Here is the critical hook: markets do not reward belief, they reward timing and scale. Large players do not need silver to reach $100 to profit. They need volatility, liquidity, and a steady inflow of buyers willing to hold positions while others exit. Optimistic price targets help create exactly that environment. Each new participant adds depth to the market, making it easier for earlier entrants to reduce exposure without collapsing the price. This is not manipulation in the cinematic sense, it is how speculative markets structurally operate. Media amplification plays a crucial role in this process. Price forecasts framed as analysis circulate rapidly, detached from the interest behind them. The line between explanation and promotion becomes blurred. Analysts who miss previous moves regain relevance by projecting bold targets, while platforms benefit from engagement driven by excitement and fear of missing out. The narrative sustains itself not because it is proven, but because it is useful. What gets lost in this optimism is asymmetry. Institutions can absorb drawdowns, hedge against reversals, and adjust positions across multiple instruments. Households and small investors cannot. When expectations are inflated and corrections occur, as they always do, the costs fall unevenly. The same narrative that encouraged participation offers no protection when prices reverse or stagnate. The most revealing aspect of the $100 story is not whether it eventually comes true, but why it becomes dominant at certain moments. It surfaces when markets need fresh confidence, when earlier positioning seeks confirmation from broader participation. In that sense, the narrative is less about silver's future and more about the present needs of speculative capital. The question, then, is not whether silver can reach that number, but who benefits most from everyone believing that it will. When silver prices rise sharply, the movement is often celebrated as proof of economic strength or renewed demand, but this interpretation misunderstands what precious metals actually represent in a modern economy. Silver does not surge because the system is healthy. It surges because confidence in that system is under strain. Precious metals function less as indicators of growth and more as barometers of stress, revealing tensions that official statistics and optimistic projections tend to conceal. The key hook is this: if the economy were truly stable and broadly prosperous, capital would not be rushing into metal that produces nothing, hires no one, and generates no income on its own. In periods of genuine economic health, investment flows toward productive activity, factories, research, infrastructure, and labor. When those avenues appear uncertain or unprofitable, money seeks shelter instead of expansion. Silver becomes attractive precisely because it stands outside the promises made by governments, central banks, and financial institutions. Persistent inflation plays a central role in this shift. Even when official measures claim moderation, households experience rising costs in essentials such as food, housing, and energy. Over time, this erodes trust in currency as a reliable store of value. Silver, like gold, benefits not because it guarantees wealth, but because it limits exposure to policies that steadily reduce purchasing power. Its appeal is defensive, not aspirational. Debt deepens this dynamic. Modern economies rely on continuous borrowing to sustain growth, consumption, and financial stability. As debt accumulates, it constrains future policy choices and increases reliance on accommodative monetary conditions. Low or negative real interest rates become a necessity rather than a temporary response. In such an environment, holding cash becomes costly, and non-yielding assets like silver become comparatively rational. The metal reflects the distortion created by debt dependence. It does not resolve it. Another hook lies in the nature of financialized growth. Asset prices can rise while wages stagnate and productivity gains fail to translate into broad prosperity. This disconnect creates the illusion of strength alongside lived economic insecurity. Rising silver prices expose that contradiction. They signal that while financial markets may appear robust, underlying confidence in long-term economic balance is weakening. Silver, then, is not a vote of confidence in the future. It is a hedge against uncertainty about it. Its rise communicates skepticism toward monetary stability, concern about inflation persistence, and doubt that current growth models can deliver durable, shared prosperity. When interpreted this way, silver's ascent is less a success story and more a quiet critique of an economy that increasingly asks people to protect themselves rather than trust the system designed to protect them. Volatility is often celebrated as opportunity, but in reality it is a sorting mechanism, separating those with structural advantages from those without them. When silver prices swing sharply, the movement is not a level playing field. Volatility does not distribute risk evenly, it channels it downward. Those with the least capacity to absorb losses are exposed most directly, while those with scale, leverage, and institutional access are positioned to manage or even monetize uncertainty. Here is the hook: most people miss. Volatility is only dangerous if you cannot wait it out. Large institutions can. They operate with diversified portfolios, access to derivatives, and the ability to hedge positions across multiple markets. A sudden correction in silver is not a crisis for them, it is a line item. For households and small investors, the same move can mean forced selling, margin stress, or the abandonment of a strategy at the worst possible moment. Time, in volatile markets, is a form of power. Liquidity amplifies this imbalance. Institutional players can enter and exit positions with minimal friction, often executing trades in volumes and at speeds that are inaccessible to the public. When prices rise rapidly, liquidity appears abundant. When sentiment shifts, it evaporates. Spreads widen, volatility spikes, and the cost of reacting increases. Those who entered late discover that markets are easy to join but expensive to leave. Another critical hook lies in the psychological dimension of volatility. Sharp price movements trigger fear and euphoria in quick succession, encouraging reactive decisions. Professional traders design systems to reduce emotional interference. Retail participants experience volatility directly, often without the tools or experience to manage it. The result is predictable: buying into strength and selling into weakness, reinforcing losses rather than protecting against them. Risk management itself is unequal. Institutions routinely use options, futures, and complex strategies to define downside exposure. These tools require capital, expertise, and regulatory access that most individuals do not possess. Without them, volatility is not a tradable feature of the market, it is a threat. The narrative that everyone has the same opportunity collapses under the reality of who can insure against risk and who must simply endure it. Volatility also obscures accountability. When prices fall, losses are framed as personal misjudgments rather than structural outcomes. Individuals are told they failed to time the market, ignored signals, or acted emotionally. What remains unspoken is that the market itself is designed to reward those who can withstand instability and penalize those who cannot. In this sense, volatility is not a temporary condition, but a permanent feature of a system that concentrates resilience at the top while transferring exposure downward, turning uncertainty into a quiet but powerful mechanism of inequality. Holding silver is often framed as an act of independence, a way to step outside a fragile financial system and reclaim personal control over wealth. That idea is emotionally powerful, especially in times of uncertainty. But here is the critical hook: ownership of an asset does not equal ownership of the system that determines its value. Silver may protect against certain risks, yet it leaves untouched the deeper structures of power that govern money, credit, and economic outcomes. Monetary policy is decided far from commodity markets. Interest rates, liquidity programs, and emergency interventions are set by central banks whose mandates prioritize financial stability over distributional fairness. Owning silver does not grant influence over these decisions. When policies shift, silver responds, but it does not participate. It reacts to power, it does not wield it. This distinction matters because protection is not the same as agency. Another hook lies in the illusion of neutrality. Silver appears apolitical, existing outside institutions and governments. In reality, its price is deeply entangled with them. Exchange rules, futures markets, leverage limits, and settlement mechanisms are all regulated within the same framework that governs conventional finance. Large participants navigate these structures with legal teams, lobbying power, and privileged access to information. Individual holders remain price takers, regardless of how much metal they own. Even as a hedge, silver operates defensively. It can preserve purchasing power in certain conditions, but it cannot redirect investment toward productive uses, raise wages, or stabilize employment. It does not finance schools, modernize infrastructure, or strengthen public services. In that sense, widespread movement into silver reflects a retreat rather than a solution, a collective acknowledgement that the system is not working as promised, paired with an absence of tools to change it. There is also a temporal hook. Silver protects value over time, but power operates in real time. Policy decisions can reshape markets overnight. Regulatory changes, margin adjustments, or shifts in interest rate expectations can overwhelm long-term hedging strategies. Those who control these levers do not need to hold silver to benefit from its movements. They benefit from the conditions that make those movements possible. The deeper issue is structural. As long as money creation, credit allocation, and crisis management remain centralized and insulated from democratic accountability, individual hedging strategies will remain limited in scope. Silver can soften the impact of instability, but it cannot prevent it. It offers insulation, not influence. The popularity of silver, then, should be read carefully. It signals a desire for safety in a system perceived as unreliable. But safety without structural change is fragile. Without addressing who controls economic decisions and how their consequences are distributed, silver remains a personal response to a collective problem, useful, understandable, but ultimately constrained by the very system it seeks to escape. When capital begins flowing into commodities like silver, rather than into productive investment, it reveals more than a shift in market preference. It exposes a deeper political, economic contradiction. Economies are meant to channel surplus toward activities that expand capacity, improve living standards, and generate long-term stability. When that process stalls, capital does not disappear, it looks for refuge. Silver becomes attractive not because it builds the future, but because the future feels uncertain. Here is the first hook: commodity surges often signal a loss of confidence in shared outcomes. When businesses hesitate to invest in new factories, technology, or workers, it is rarely because opportunities do not exist. It is because the returns are uncertain. The risks are socialized and the rewards are increasingly concentrated. Under such conditions, holding metal can feel more rational than building something vulnerable to policy shifts, demand shocks, or financial instability. Income distribution plays a central role in this dynamic. When wages stagnate while productivity and asset prices rise, consumption becomes debt-dependent and growth becomes fragile. Capital responds by favoring assets that can preserve value rather than expand employment. Silver's rise reflects this imbalance. It signals that the economy is producing wealth without broadly distributing purchasing power, undermining the very demand that productive investment depends on. Another hook lies in the transformation of growth itself. Modern economies increasingly reward financial engineering over production. Profits are extracted through arbitrage, leverage, and speculation rather than innovation and output. In such an environment, commodities function as financial assets, detached from their industrial role. Silver's surge highlights this shift. It is not rising because of manufacturing demand alone, but because it has been absorbed into a financial system searching for stability it no longer generates internally. Public investment failures deepen the contradiction. Infrastructure decays, education systems strain, and healthcare costs rise, yet capital hesitates to engage where returns depend on long-term social planning rather than short-term profitability. The result is a paradox: abundant capital coexisting with unmet social needs. When silver attracts funds that could have modernized economies, it quietly testifies to policy choices that prioritize market signals over collective investment. The final hook is that commodity booms are often mistaken for solutions rather than symptoms. Rising silver prices do not resolve inequality, restore wage growth, or rebuild confidence in institutions. They simply provide a temporary store of value while underlying tensions remain unresolved. In this sense, silver acts as a mirror. It reflects an economy struggling to align private incentives with public outcomes, revealing a system where preserving wealth feels safer than creating it, and where financial refuge becomes more attractive than shared progress. So let me close with this thought. Silver did not suddenly hit $64. Capitalism once again revealed its contradictions between paper and value, between promises and production, between those who decide and those who react. The trap was not set by the metal. It was set by a system that teaches people to look at prices instead of structures, numbers instead of power, and hope instead of change. If we want a future where people do not have to flee into commodities for safety, then the conversation cannot stop at silver charts. It must move, uncomfortably but necessarily, toward how our economic system is organized, who it serves, and who pays the price when it inevitably destabilizes. Thank you.